Welcome back, everyone. We've had a pretty volatile week where the S&P at one point was up just over 0.5%, and then a couple of days later it was down over 1.5% before ending the week slightly down by about 0.2%. My portfolio managed to eke out a gain where it is up a whopping $17 in the last week. I also bought a little bit during this week with some buying into Verizon, SCHD, Apple, Johnson & Johnson, Store Capital, and putting more into the indexes. So overall, I think this week has been pretty good for me personally because I did outperform the market, but it's just a short time frame, so that doesn't really mean too much right now. But for this week, I wanted to get into why I think that dividend growth investing is one of the best methods to grow your wealth into the future. I think there are three main ways that dividend growth investing can help your portfolio grow, with the first one being through capital appreciation, just like every other stock that's out there. A lot of the time, the companies that are in dividend growth portfolios aren't going to be appreciating in value like this new and up-and-coming tech companies. However, in return, you get a more consistent growth with lower volatility. There are some companies like Apple, which have the best of both worlds, where Apple is still growing really quickly while also paying out a dividend every year. Another way that this method of investing is really powerful is, of course, the dividends. Dividends are payments that a company gives to its shareholders just for holding those shares. No extra work needs to be done, and cash just shows up in my brokerage, and I'm free to invest it wherever I'd like. I don't even have to invest it. I can take it out and use it just as good as cash. Most companies that pay dividends pay at least once a quarter, and the amount depends on the company. Apple, like I mentioned earlier, has a really low dividend yield. Its current dividend yield is just over 0.5%. But then there's other companies like AbbVie, which has a much higher dividend at over 4% a year. Now, some people will say that getting paid a dividend is just the same as me selling a portion of my holding because the stock price decreases by the same amount as the dividend that was paid. This does happen where it will decrease. A lot of the time, it will be at the same value it was the next day. It'll just grow back to where it was. So that doesn't really matter. But then I'm also not lowering my total ownership in the company. When Apple pays their dividend next quarter, I'll still have the 19 shares that I do now. My ownership doesn't change whatsoever. I will still have all of this ownership. A lot of these companies that pay dividends make so much money that they don't have anything else to put it into. Apple makes hundreds of billions of dollars a year, and there's just not that many opportunities for them to go into. They don't need all of that money. So instead of just wasting it, spending it on pointless projects, it's a better return on their capital to just pay it out to their shareholders. And as I said earlier, with the dividends that you get paid, you can do whatever you want with it. You can reinvest into the same company and make the next payout you get from them even larger. You can put it into a different company if you think that's a better deal. Or you can withdraw it from your brokerage, put it in your bank account, and spend it anywhere you'd want to. With reinvesting the dividends, the amount that you get paid increases every single time, and this grows faster and faster and faster until it grows to be a larger payout than what you can contribute. And at that point, your dividends will grow your portfolio faster than you ever could. Finally, the last and my personal favorite part of dividend growth investing is the dividend growth part. This is where companies increase the payouts that they give every year. Some companies are growing their dividends aggressively, like AbbVie, which has a 5-year compound annual growth rate of 18% through its dividend. While I don't think that this is sustainable for the long term, for right now, this is incredible growth. I think in the future, this will come down. It has already started to come down a little bit because their last increases have not been almost 20%. They've been around more 10%, which is still incredible growth. The weighted average for all of these growth rates for my portfolio is 9%. So without putting any more money into my portfolio and just letting and not even reinvesting the dividends, if I took the dividends out and I stopped putting money in, the amount that I would get paid every year would still increase by about 9% year over year. And if I do put more into the portfolio and reinvest the dividends, it's going to go like way faster than that. Some of the most recent increases that I've gotten was from Bank of America, where they increased their dividend by almost 17%. JP Morgan is going to increase their dividend next quarter by about 10%. And Home Depot, a few months ago, increased their dividend by. These increases are like buying more shares from before the increase, but it's completely free for me. With Bank of America's trailing yield of 1.8%, its 3-cent raise over the 27 shares that I own is like me getting a free $45 invested more into the company. Once my portfolio grows even larger, then the dividend increases will be even a more dramatic increase in value. Dividend reinvestment is so powerful that if you go back to 1970 to now, 84% of the total return of the S&P 500 can be attributed to reinvesting the dividends. If you put $10,000 into the S&P 500 in 1960 and just held it there till now, you'd have $627,000 if you didn't reinvest in your dividends, which is great growth. This is incredible. But if you did reinvest your dividends, it would grow to $3.8 million. And that's a huge increase. So this really just shows how powerful dividends are in growing the value of your portfolio, as well as giving you cash flow at the same time. Now, of course, there are going to be downsides to dividend investing. As I said earlier, your share price probably won't appreciate as quickly as it would with a tech company. You also have to pay taxes on your dividends. Even if you reinvest them in the same company with the DRIP programs or whatever, you still have to pay taxes. Now, the taxes on dividends are going to be lower than they would be for your ordinary income. The dividend tax rate is the same as capital gains, the long-term capital gains rate, as long as you've owned the companies for over 6 months. So a lot of the times when, like next time I get my payout from Apple, when they pay me their $4, I'll pay 15% of that into taxes. So it's definitely not nearly as bad as earning income, but it's still kind of annoying to have to pay the taxes on it. Now, one exception to the tax rate is with REITs. So I have 2 different REITs. I have Realty Income here and Store Capital here. And both of these, I have to pay ordinary income taxes on them. So when Store Capital pays me their $25, I'll have to pay whatever my marginal tax rate is for the rest of my income. REITs aren't taxed the same as all the other companies, so you have to pay more in taxes when you get your payouts. But in return, you get a higher yield from them, so it balances out. But despite having to pay taxes on all of this, I think this is still worth doing, because when you have growth companies, for instance, you might not get paid dividends, but when you sell them after holding them for 10 years, you still have to pay capital gains on it. So at some point, you're going to get taxed on it. So I figure spreading it out makes it seem like it's not as bad, because at least right now, it's not really something that I notice when tax time comes. Now I'd like to go over an example of how powerful dividend growth investing is over long periods of time. I'm going to be using the historical performance of my portfolio for these numbers. Now I'd like to mention that I don't think that a lot of these companies in my portfolio will be able to keep up this high double-digit growth of their dividend for this long in the future, but it's the best data that I can use right now. So if we go over here to this website, which is a dividend calculator to project how much your portfolio will be valued over time, we can input my current portfolio value, which is at $35,000, and I currently have an annual contribution of $24,000, which is what I've been doing for the last year. My current yield, if you were investing into my portfolio, is about 2.65%, and the 5-year CAGR of my portfolio is just over 9%, so we're going to be using that. Even saying that the share price appreciation will be lower than the overall market, which I'm hoping that it will at least match it, we still see explosive growth. If we put in 20 years here, we calculate what it'll be at the end. So in 20 years, the portfolio value will be at $1.9 million. I'll be making just under $300,000 a year in dividends. The first few years of investing in this way, there isn't going to be a lot of growth, because most of the money comes from what I'm putting in, where the annual dividend income is increasing by $900 and then $1,000 and another $1,000. So it increases pretty slowly at the beginning. But then towards the end, we get from, once it passes where I can contribute, it grows by $9,000 a year, $10,000 a year. And at the end, it grows from $130 to $170, so $40,000 a year, $50,000 a year, $60,000 a year. And most of this is just coming from the appreciation of the dividends and the share price. It's not from what I'm putting in. At this point, what I'm putting in doesn't really matter that too much. And if we just wait 5 more years, this growth becomes even more apparent because we have more of this exponential time that we're waiting through. So just adding 5 extra years increases the portfolio value by over $3 million, and the annual dividend income increases by $900,000 in just 5 extra years. So it's absolutely insane to see how much this grows once this snowball really gets going. With that, I'm going to see you all next week. If you enjoyed the video, be sure to like and subscribe. If you have any more suggestions about other topics you'd like me to talk about, or any questions you have for me, you can leave them in the comments or email me at jacobmorrisinvesting@gmail.com. See you next week. Bye.